Good afternoon, everybody, and thanks so much for joining us for today's monthly market update. My name is Marianne Hensley. I'm the VP of Media Operations here at FreightWaves, and excited to be joined by our very own Anthony Smith, our economist, and our Sultan of Sonar, Zach Strickland, who will be sharing insights around the latest happenings in the freight market today and how those affect you. Before we get started, just a couple of quick items. First, if you have any technical issues, you can reach out to our team through the chat button in your control panel. And if you have questions for Anthony and Zach at the end of the presentation, you can enter those through the Q&A button in your control panel. At this point, I'd like to go ahead and welcome Anthony and Zach. Welcome, guys.
Hello, hello.
How's it going?
Great. I'm excited to be here with Zach Strickland, the Sultan himself, yourself, talking about some freight and economic trends.
Yeah, we've got peak season coming up.
We've got peak season.
All right, let's dig on into it. Do you want to give the whole spiel about who we are and what we do? Or?
I'll give part of the spiel.
Okay.
How about that? I'll give part. So FreightWaves, who we are, we're a world-class community. And what we do is we analyze deeply the freight market, the freight industry from every single aspect. We have market experts from all across, from every segment of essentially the freight market, right?
Freight market. Well, we've got an economist.
We have an economist here.
Intermodal expert, final mile expert,
shippers,
shipper
carriers,
experts,
brokers, a sultan.
Yeah, then there's that. All right. So yeah, we got a lot of people doing a lot of hard work. We're pulling together data, and not to be undersold is the data team. The data team is what makes this possible. Lots of data science going on, lots of statistical analysis, trying to figure out what is the most relevant and predictive and useful information out there in the market today. And then we help them translate that to something usable.
That's right. Known as tribal knowledge.
There it is.
We have the tribal knowledge that it can be translated into these data points that are useful and translatable into day-to-day actions and implications.
Yeah. Well, all right. I'll let you take off with the economy. Anthony,
sure.
Let us know how the economy's doing right now.
Oh, at this moment, we're going to do a manufacturing update. What's going on with that? Have a little bit of surprise, not really with the manufacturing. Retail sales had a nice rebound, and we're going to get into housing construction trends. My summary: manufacturing isn't invited to Thanksgiving. We got the latest industrial production numbers.
Well, manufacturing's been kind of a lagging performer over the last couple of months. Is that right?
Correct.
Manufacturing, of course, is a big producer, big mover in freight.
Right.
Yeah, but retail
sales made a nice rebound.
Yeah, and so that's good news.
Good news. So a little bit of mixed bag.
We're about to get into that time of year. So, yeah, and we've, volumes have fallen in the freight market over the last couple of weeks or so. Capacity's loosened up a little bit more than we'd like for it to, leading into peak if you're a carrier. But at the same time, the market conditions are relatively flat. They're not dropping below, spring levels or anything like that.
Right.
So, let's kick us off with this manufacturing.
Right. So manufacturing is underperforming, as you said. It's been really lagging throughout the economy. And with the latest data from the U.S. Census Bureau, the Federal Reserve, we see that industrial production came in at down 0.8% month to month. So this is also down 1.5% the year ago levels. A lot of I think the big component that people related to freight are going to care about is that machinery component, which was up slightly month to month, but is still down 4.5% year over year. When we're looking at industrial production, a big part of it is going to come from manufacturing, and over 70%. And that major aspect of manufacturing that has those implications for freight is really going to play a toll when we're looking at not just the overall economy. It's going to make about 12 to 14% of overall economy, but when we're looking at the movement of freight. And so one of the trends that we saw with manufacturing this month was there was a GM strike that still weighing on some of the data that's been published most recently. But even when we exclude autos, the industrial production manufacturing segment is still down 0.5%. So it still has autos accounted for a huge chunk of it, a substantial chunk of it, but it's still down without autos. So auto production isn't to blame solely for industrial production.
Do you think, GM just turned back on, a few weeks ago, and we have seen a lot more increased volume in those areas. as they kind of try to recover from
Right.
that. Do you think that'll show up in next month's figures, or will that show up a little bit further down the line? Is this more of a completed
Mhm.
figure, or is this pre-production?
This is more of a completed figure. So I think this is going to show up more down the line as things really start to ramp up. But I think even with that boost, there are still so many areas of weakness when we're looking at manufacturing. So, for example, machinery, that big component that's still just not quite enough to really support overall manufacturing. And in fact, when we look at manufacturing, the big thing is that we have here is our seasonality format for our industrial production manufacturing here. And so what we're doing is that we're comparing it to last year's levels. And when we're looking at manufacturing, it's been down 5 out of the 10 months so far. And we're really seeing that in that green line, we have last year's results, and this year we have the blue line, this year's results. It is really a separation of the two.
Yeah, you're starting to see that divergence
Right.
show up a lot more. Did we have too much? I mean, were we looking at an overheated comp historically in 2017-18 versus now? Or are we coming back to normal? Is this still like a very soft market?
For one, I think you're right. It was very hot, I think, last year. But I think in addition, it was, I think, a little bit of both because we are looking at a very soft market, especially when we're looking at business investment. That's really been lacking. A lot of uncertainty. Where do we invest? How are we going to invest? Are we going to bring in more individuals for certain parts of the manufacturing segment? And what's going on with tariffs? And so there's been a lot of uncertainties that have mixed in there. And then also, like you mentioned, last year was just really hot. It was really a lot of activity when we're looking at manufacturing. So it's a little bit of both. Worst case scenario, I think, on both ends, hot or high comps, and then overall weak market when we're looking at the most recent month so far.
Yeah. So, I mean, I guess it really doesn't matter because the market adapted up
Mhm.
and now it's coming back down.
Right.
So, yeah.
Right. And so up here we have what we have is the Purchasing Managers Index. And so a lot of people are looking at this right now, and they're getting a little bit optimistic because we've seen the contraction in the PMI. For those of you who don't know, the PMI is based around the number 50. So anything above 50 is indicative of growth. Anything below 50 is indicative of contraction. So when we're looking at the PMI, we see that it's still under that 50 threshold. So this is people are starting to say, hey, maybe it's found its bottom because it's starting to increase. It's 1 month of rise. I think more importantly, we're seeing rise in new orders, but still it's too early just for off of that 1 month to say, hey, things are turning around here. Although it's followed closely with industrial production in the past and it's in a forward-looking indicator, I think maybe this could be a sign that perhaps there'll be more prospects going into actually as we're in 2020. But I think as we're looking at the remainder of the year, I really don't see that being a big factor when we're looking at industrial production or manufacturing as we're going into November and December.
Yeah. So, new orders really are a leading indicator in the industrial economy.
Right.
The ISM, of course, it looks like it's got a lot of momentum in it, though.
Right.
Am I wrong on that?
Yeah, it's some momentum building, especially in that new orders component. So that's really going to track the committed orders that are on tap to be produced in the coming months. And so new orders are, can be canceled, but usually it does a pretty good job of tracking into production. And then you can see production follow closely to new orders. And then even if some of those new orders come in late, you can still see that sometimes production outpaces what we initially had thought was going to be for new orders. So new orders is a really good sign of showing the initial direction of where you can expect for production. And then in line with that, it tells us what we can expect for shipments, which is really going to be the pivotal thing for freight shipments and transportation.
I think the good news here is that we've really, decelerated at least,
Right.
if nothing else,
Right.
because the last couple of months in this index has really been a fall from grace.
Exactly.
Yeah.
Exactly. On the other side, we're looking at non-durable manufacturing. We're still seeing some life there. So although we did see a decline of 0.6% in October from September, we're still seeing that it's not free falling as the manufacturing side of things. And so when we're looking at non-manufacturing, it's going to include things like food, beverages, and things that need to be in a refrigerated trailer. So we have this here compared to our reefer outbound tender rejection index. And so cool thing about this is that we see it track very closely with our RO try. And so that this tells us, we get a little bit of a sneak peek as to what's happening with a lot of these highly watched or highly visible monthly indicators when we're looking at government publicly available data that's issued by the U.S. Census Bureau or the Federal Reserve. We get a head start. We get a peek as to what's really on tap here. And when we're looking at the reefer outbound tender rejection index, we see that we start to see a little bit of an evening out, even a rise in non-durable manufacturing, when we can see what's happening on the ground in the trenches, as you could say, on a daily basis. And so when we're looking at that, we can really start to see what's happening, what's on tap for the industrial production side of the non-manufacturing side of industrial production.
Yeah, we've been tracking on the freight side. Reefer demand has gone up a pretty good bit, at a pretty good clip. We actually have seen reefer demand eclipse that of June, which is traditionally reefer peak, where you have a lot of the produce and it's hot. Generally in the summer. We do have a secondary season in reefer demand in November over the last couple of years, but it is interesting to note that the reefer demand has seemingly eclipsed that of summer peak. Now, it hasn't translated to rates specifically just because overall demand is softer. But at the same time, it's interesting to see that the reefer segment and this non-durable manufacturing segment are both kind of falling in line. They're not on as much of a rapid decline as the dry van and the manufacturing.
Right. Next up, we're transitioning into housing starts. So with housing starts, we saw a nice little jump up in the most recent numbers that came out today. As you mentioned, we have a data team, and the lovely data team. Shout out to Brad Hill and Eric Crowley for pulling in this data so quickly into our Sonar platform. Getting it ready for us here today. But what we see in the latest data is that there was a rise of 3.8%. And I think the big thing here is single family starts were up 2% month to month.
Now that's the bigger number, right?
That's correct. Yeah. That's the bigger number. So it accounts for much more of the total starts compared to.
So anybody dealing with construction and that kind of thing, like redevelopment, that type of stuff, they should see increasing freight volumes potentially.
Yes.
It's looking a lot better. I know it's been on kind of a decline, but we're starting to trend a little bit higher.
Right.
Now I noticed that your housing sentiment, which I put a lot of faith in.
Yes.
It's starting to slide back down. But go ahead.
Yes. I put a lot of faith in how people feel, Zach. And Marianne, it makes sense, right? If you feel good about buying a house, you're going to buy a house.
I mean, you would think so.
You would think so.
I don't know about
Zach. Zach doesn't think so.
He's not on board.
Purchase with emotion.
This is what the U.S. is built off of. But when we're looking at the HPS side, the Home Purchasing Sentiment Index, we have seen a double dip. It's fallen for 2 consecutive months, but this is down from historical highs for the index. So it's still relatively high. Big thing for housing starts is on the single family segment, that larger segment is that this is the 5th consecutive rise for single family starts. And so that's a really big thing here because we're starting to see some momentum building up. Other thing is that the West, because it's broken down into regions, South being the largest, West coming in second, and then I believe Midwest in third, and then Northeast is last. And we're talking about the amount of housing starts for each region. So West, second largest, is up 17.6% month to month. And so that's really showing us that the big players, the big regions are really starting to pick up momentum. Still, there's going to be some supply side issues when we're looking at this demand. Also,
I mean, the costs have gone up still, correct? Has that been a headwind for the housing market over the last year or so?
That has, especially when we're looking at available lots to build on. That's driving prices up. When we're looking at existing homes, because it's going to have to compete with existing homes, that inventory is tight there, so that's going to drive prices up. There's a demand there's a lack of skilled labor, so that's going to start to drive prices up on the supply side. And there's definitely a huge demand for entry-level and mid-level homes. And so these are things that are really kind of culminating into this aspect that we have a demand, but we don't quite have the supply. Now, and you're going to like this one. So the National Association of Home Builders, they put out a housing market index.
Okay.
Zach, this is essentially sentiment on the builder side.
Oh, yeah.
And so when we're looking at this NAHB Wells Fargo housing market index, it's still relatively high. I think it went from 71 to 70. And so we're seeing that builders are still optimistic about the housing market.
Let's clarify here, like how predictive is our feelings or the sentiment, if you will, from the builder's perspective? Like if we see builders being positive, does this translate into housing starts at some point?
It does, and it does translate. It tracks pretty closely to housing starts. Okay. It tracks pretty closely to the overall industry. But they all, because these are the builders that are also in the trenches, if you will. And so they really get that peak of, hey, this is what business is looking like coming down the line. This is my situation when it comes to labor. This is my situation when it comes to available projects and things like that. So it does a decent job.
Okay, so it's basically a good indicator of their activity, what they've been seeing, and then their cost prospectus and all that. So they're basically thinking, I'm going to be, it's a combination of cost and activity that's not that bad.
Right.
I'll give you a little bit.
Okay. All right. I'll take the little victories. Yeah. A little bit. Next up, we have construction spending. So straight in from housing starts, construction spending. When we're looking at construction spending, we're seeing that there was a recent bump up on a month-to-month basis, but it's still down 2% year over year. And so overall construction spending, a big chunk of that is going to be residential construction spending. That's just going to be, where overall, that's where most of the activity is. When we're looking at construction spending on the residential side, it's still down 3.5% year over year, despite being up slightly month to month. And really that's really going to translate into more building products being moved and hauled throughout the country, especially when we're looking at flatbed trailer.
Or anybody that hauls for Lowe's, Home Depot, Menards, it translates into other things as well, such as furniture.
Exactly.
So these are all, good news for freight providers out there, but also some of the shippers out there that are expecting, maybe a softer year.
Exactly. Just as you hit the nail on the head of that one. When we're looking at construction spending, and that's one of the things that I think a lot of people forget about when we're looking at housing starts, construction spending. The downstream effects. They're filling those houses up with stuff, right? They're filling it up with new furniture, appliances, new TVs. Got a new TV, and so they're filling that up with stuff when they're making a move, when they're building a new house and things like that. So there's a lot of downstream effects here when we're looking at construction spending.
Okay. And that's as of the end of September.
Correct.
And we're watching the flatbed outbound tender rejection index there go a little flat, a little sideways.
Right. So that gives us a little bit of a sneak peek as to what to expect when we're looking at construction spending.
Month.
Right. Exactly. And the other thing is, when looking at construction spending, a bright spot is coming from public spending. Now, it's a smaller segment, but when we're looking at highway and street construction, that's been ramping up quite a bit on the public side. So there are opportunities coming from the public side. It's just that the bulk of construction spending that comes from residential side is still down and still lagging in the overall, aspect when looking at housing construction.
Gotcha.
Next up, we have retail sales. So as I mentioned earlier, retail sales rebounded and is now up 0.3% in October. So
this is a big one because we just watched a bunch of retail stocks take big hits today in the stock market.
Right.
Correct? So how is that showing, why is there such a disparate? I mean, I know the stock market is somewhat disconnected from fundamental analysis at this point, but what's happening here?
So I think when we're looking at retail sales, there was a decline. So peeling it back, there was a decline in big ticket purchases. And so when we're looking at that, we're also looking at things like pricey furniture or big durable goods, these big ticket items that might have some implication to some of these stocks that take a hit. And so these are the things that are really starting to take a hit when we're looking at the shakeup with overall retail sales. And so that could be some of what was driving some of those retail side stocks. Also, there could be a shakeup in consumer activity. When we're looking at this, we're going to, oh, you know what, let's just go to it now. When we're looking at this, consumer credit, I think we were chatting about this
We were.
FreightWaves Live in Chicago. Consumer credit increased by 9.5 billion in September, and this is a comparison to 17.8 billion in August. And so um, that's the thing. We want consumers to spend because it's a big side of the economy,
Sure.
but we don't want them to overextend themselves. And so it's still strong. It's still, I think, 1.8% or well over 2% above the year ago level. But that's a notable decline, 17.8 billion to 9.5 billion. So consumers might be getting a little bit more discretionary, especially when it comes to these big ticket purchases. And as I mentioned earlier, the decline in big ticket purchases from things like furniture and electronics and appliances. We can see that decline there in the green line for retail sales of furniture and appliances in conjunction with the outbound tender volume index.
So we're effectively seeing a little conflicting information here because we've got growth in retail sales overall, but this particular segment. But we also saw some increasing in construction spending, which should eventually lead into big ticket item purchases, correct? So maybe a little bit of more, we should expect a little bit more flat activity in this.
I think so. And I think it's going to, I really am interested to see how holiday season, I think everyone's going to be watching with bated breath to see if consumers show up for those.
Yeah, there's a lot riding on these next couple of weeks in the freight market. I think our next month's freight market analysis will be far more interesting in terms of what we can recap and what we're seeing right in the middle of the holiday season.
Right.
You know, we'll be right there, right before Christmas, but after Thanksgiving.
Exactly.
There's a lot of uncertainty going on right now. We're seeing some mixed signals. So
Exactly.
I think what you're saying is pretty true.
Yeah, and I just chatted with David Folkenberry, a final mile market expert.
Right.
And he was telling us about how peak season for retail sales of things like furniture items during the winter moments, you know, we're inside a little bit more. We start thinking about buying new furniture, buying new electronics. He said there's a big pickup, especially before Super Bowl for big screen TVs.
Yep.
He also gave us a nice little story that there used to be a big return spike right after the Super Bowl of people trying to return those big screen TVs after the Super Bowl. But like as you mentioned, we're going to be watching closely when we're looking at consumer spending, whether they're going to show up, whether they're going to have the confidence, the sentiment to spend. When we're looking at things like the employment numbers, it's still good. But all the time when I'm looking at employment numbers, I always want to peel it back. What are the jobs that are being provided? Are these jobs that are going to sufficiently boost the economy? Now, we have a pretty good participation rate because I think many of us know if you're a discouraged worker and you're no longer looking for employment, you get dropped off of that measurement. But we have a pretty good participation rate right now. Not a lot of discouraged workers, but the quality of jobs, when we're looking at employment, we're seeing a lot in the service side, especially when we're looking at healthcare. A lot of that's below the national average take home. I think it's below I think it's right around $35,000 to $45,000. And so we're looking at that. It's really easy for someone that has a lower salary to get spooked when we're seeing any kind of price increases passed on to the consumer. So that's another little aspect that we're going to be watching closely when we're looking at employment and consumer trends. Next up, we have the Logistics Managers Index. So this is at a historic low, Zach. It came in at a 54.4. It's a lot like the PMI.
Yeah.
Anything above 50, growth. Anything below 50, contraction.
But again, built on some momentum here. So we've fallen from like 90.
Yeah.
If I'm not mistaken, like somewhere over 90. You know, in 2018, and now it's all the way down close to 50 again.
Right. And so this exact moment last year it was at 71.4, and so in comparison to the year ago levels, this is a dramatic difference here. When we're looking at this, we're seeing that the pricing components of the LMI. Also, quick shout out to the people the fine folks that put together the LMI.
Oh, right.
Arizona State, Colorado State, Rochester Institute of Technology, Rutgers University, University of Reno, Nevada, and I believe with the conjunction of the Council of Supply Chain Management Professionals. So a lot of teams pulling together for this LMI here. And what we see in the LMI is that prices components is down to 43.5.
And we are right in the middle of bid season. So
Yes.
it is, I would expect that number to continue to slide down.
Right.
All the feedback and all the data we're seeing is basically saying everything that they got last year in terms of rate increase is basically going down.
Exactly. And then we also have a capacity component, which is up.
Well, yeah, capacity is still oversupplied. Not a secret there.
Right.
But yeah, it's basically a lot of validation
Right.
for what we're seeing right now in the freight market. So,
exactly. And with that, I
guess
hand
we'll
things over to you.
dive on into that freight market update. So tender volumes, as I mentioned, actually dipped back under 2018 levels just briefly, just for about a week and a half or so, which still, basically the way I look at this is that freight volumes are essentially flat year over year. We're going to bounce around the same level. You can see there's a lot of seasonality in here. I do find it interesting if you look at this, the chart here, that, almost simultaneously, 2018 and 2019 have a big push up about the same time. Now, what's interesting to note is that Thanksgiving timing this year is a lot later than it was last year. So we are seeing some interesting patterns of behavior in the community where volumes are moving on almost the exact same day regardless. I think that's fascinating to me. And it's not like, we're going to have Tuesday last year and Monday this year. But yeah, volumes are starting to pick back up and, right as we would expect in sync with, leading into peak. Traditionally, November is a big hit or miss situation. All right. The big driver of the volumes over the last year actually has been a lot of regional volume movement on the West Coast. West Coast has had, with the trade war and everything, we had a huge amount of imports, which I'll cover here in a little bit. A lot of these imports come into Los Angeles and then they get repositioned across the area, waiting for a final destination or a DC on the East Coast potentially or the Midwest. They'll hop on the rail, go to Chicago, go to Atlanta, go to Dallas. And essentially sit there and wait. And a lot of this was due to the trade war really influencing a lot of shipper behavior into saying, I want to get in front of these tariffs. A lot of these suppliers, they needed some time to source their freight differently. We've watched, the move to Southern Asia, even though the gross majority of the freight still originates in China. The scale there is just so large. We're not going to get over that anytime soon. But it is interesting to watch. I mean, Vietnam, Malaysia, all these smaller Southeastern Asia countries, they don't have the size or the scale to compete with China, but we are seeing a noted impact in, where the freight is originating. Now this, I think we've covered this on a few webinars now, that a lot of that has an impact on where the freight comes into the United States. The domestic freight market is now starting to see a lot more influx into the eastern ports versus the west, which means you're going to have a less rail volume because that's a longer haul type of freight, and you're going to see a lot less longer haul trucks. You're going to see an increase of drayage, increase of regional movements on the megalopolis, which is not an area that a lot of carriers like to operate. That's going to do a few things. Now, shippers may think this is exciting, but it may not be the best thing because now you're going to have to pay a bunch of minimums. A bunch of minimum freight, and that can over time actually be more than your longer haul freight in terms of efficiency. So you're not getting as much bang for your buck effectively on the surface transportation.
So do you think that something like this is sustainable?
Yeah, it's absolutely sustainable. Over time, the market will correct and will adapt. Now, the people that are watching it will be able to take advantage of this situation faster. They'll move their networks, they'll change their networks around this, and not rely on, anybody that's shipping off of LA right now who got used to, you see the outbound tender volume index for Ontario and Los Angeles, two of the biggest outbound markets in the United States, very active this year, active throughout the first half of the year, which is unusual. We saw about a 30 to 40% increase year over year in first half volumes. A lot of those volumes were moving intra-regionally. They were going to Phoenix, they were going to Stockton, they were going to, all these markets around the area where there were warehouses and DCs. They, some of them went into Chicago, but we saw Chicago go stale and stagnant. Joliet, Chicago markets, both down year over year in terms of outbound volume. Rail volume, intermodal volume, which I'll get into in a bit, is definitely soft as well. Here's your regional picture year over year, how things have changed in terms of outbound tender volumes. You see right there at the end, the West Coast, super active. Of course, two of the biggest markets, Los Angeles and Ontario, are big factors there. But we have seen declines in most of the West Coast markets. San Francisco, Stockton, Seattle, all down as well. They're starting to slide back down to reality. And we're starting to see that, the Northwest, I should say, has been super active this fall, a lot more so than last year. A lot of that's driven to, a lot of the produce movements. We had a really good season, apple harvest, potatoes, all that kind of stuff. But again, there's been a lot more activity in the Northwest than last year, but a much smaller market area, much smaller region, I should say, overall, in terms of general freight volume. So that percentage is maybe a little bit misleading because you're getting 25% of a much lower figure.
Right.
The West Coast is actually much more impressive to me in terms of a -6. That has a lot more weight in the overall freight market. And then, of course, we're seeing the Southeast continue to be just stagnant and flat. Anybody that hauls down there has probably noticed this. Atlanta has really become a consumer-driven market, a lot of consumption, not as much production out of that area, but also the Southeast in general, just a little bit softer year over year. So one thing I find interesting is that the long haul freight outperforming all the other freight in general continues, but we're starting to see a lot of that decline. Now, the reason this is important, like we were saying before, I'm tracking this because of that shift of shipper preference to the East Coast. Anything that moves over a long distance is going to pay a lot more revenue. It's a much more difficult network to manage, especially if you're a long haul over the road carrier that manages the entire country. As the longer haul freight starts to decline, which has not, essentially, if you see that year over year, it's actually up a little bit. But the tweener haul freight there, that 450 mile to 800 mile load, has fallen dramatically year over year. Now that's where, the rails and the long haul carriers tend to make, a lot of money on these loads because they're a little bit difficult to manage. That can be a day and a half of travel time. It's not necessarily that efficient. But as shippers basically start to move a lot of their supply chains around, and you see these regional warehouses show up, regional DCs, they're going to shorten that length of haul. They're going to become a little bit more effective and efficient with positioning that closer to the customers. But it is interesting also to note that we've watched a lot of that local haul freight, that 100-mile freight, right. Which really had a big moment this year in terms of an increase during the summer months. Has started to contract quite a bit as we near retail peak. So that's something to watch as well. So I find it interesting that we're seeing contractions in the tweener year over year and most recently the local haul freight. That's going to have a noted impact to how shippers and also carriers behave over the next coming months. Right. So spot rate activity, flat. Basically, right now we're watching tender rejection rates as well go pretty horizontal. You see there at the end, we're starting to see an inkling of an increase in overall tender rejections. Now, I would expect this to an extent. I'm honestly, I thought this wouldn't really happen this soon. I thought we would see it more, towards the end of the week, this week into next week. I expect the market to tighten a lot more significantly. Now, again, we're not expecting some sort of booming peak season. It is, it is what it is. But it is important to note that we are still up over the spring levels. This has still been a relatively flat fourth quarter so far. It hasn't been last year. I would actually say that last year, 2018, was a little bit worse thus far in terms of just general activity. I know tender rejection rates were up because we were still in that situation where everybody was operating in this assumption that we were in an undersupplied area. We were coming down off that high, essentially. It's kind of like looking at your LMI or your PMI. We were correcting to a norm, and I think the market has finally found. I don't think we're going to get that much softer, although Q1 is not looking great right now because the tradition is for capacity to increase in Q1 as well as rates to contract. So I don't know if there's much hope for those rates going much higher here after peak. So it's looking pretty grim, especially since you're showing the macroeconomic on the manufacturing side, the construction side looking better. That actually is a glimmer of hope.
Right.
Retail does not drive first quarter freight volumes. We see a lot more, everybody kind of takes a deep breath in January because they're freezing and they're not doing that much. So we don't have a lot of, is it going to be better than last year? No, I don't think so. I think what we were seeing in the West Coast last year was a lot of regional activity, keeping the volumes elevated. We were a little bit more optimistic at that time, but it really didn't have. I mean, you saw rates come way down. You see that line there, that yellow line.
Right.
Just fell off a cliff after peak last year, and it really never looked back. We had a very muted June peak, and I believe we're probably going to have another muted holiday peak here. So
not a lot of catalysts.
Yeah, the futures market is predicting a lower peak, roughly 5% lower than June and about 15% lower than last year peak levels. So 15 to 20%, I'd say. That's our DAT long haul freight REN average for spot market rates, along with the forward curve in the futures market. They're predicting about $1.48 at peak. Last year we were sitting up over $1.70. So it's it looks to be, really a horizontal market right now, and there's not a lot of expectation that that's going to change anytime soon. But that being said, we do have, some inkling that this market may have bottomed out outside of some seasonal patterns. We see intermodal moves basically in line with trucking, and intermodal volumes actually showed us, or intermodal rates, I should say, were actually pretty good in October. They outperformed the trucking market by a good bit. They managed to take rate increases where the trucking market did not. Now these rates are still down more significantly than the truckload side. These are spot rates, including fuel. And that's, the fuel only accounts for about a 1 to 2% of the rate movement upward, whereas the trucking rate does not have any fuel in that. So we have accounted for that a little bit. So really year over year, not great, but in the near term, there was some interesting movements in terms of upward rates in the intermodal side. But you see there at the end, the rates did come back down to normal just this week. So they might have captured something that they just lost.
Right.
But again, overall, it looks pretty flat. And starting to get, see, here's the intermodal volumes again. So they are down year over year. They're actually decelerating a pretty good bit as shippers are, they're not shipping as much volume, number one. And number two, they're super competitive with trucking rates. And you saw that the intermodal sector did take an increase in rates in October. That's going to further, keep shippers from using that surface transportation on that end. Again, a little bit of an overheated sector last year with all the pull forward. A lot of that had a direct impact to capacity in those local markets, the regional markets, LA. So they really needed to make sure that their freight was moving out of that area. That not a lot of options, capacity was limited at the time in those markets. So now everybody's kind of figured it out. A lot of carriers flocked to LA, and now they're dropping their rates. And now we see that those West Coast volumes have plummeted. That's going to keep rates really subdued. For LA specifically, a lot of these carriers are going to get stranded out there if they're not watching. Especially since a lot of them have really made decent money moving this regional freight, getting locked in this pattern. Now that freight appears to be drying up a good bit out there. Intermodal is definitely, the rails do a little bit better. This is intermodal on the rail, not on the trucks. It's not JB Hunt or Swift, but it is the rail movement. But the rails can handle this type of activity. They manage their rate structures as well as their capacity a little bit better than trucking, just because they are essentially an oligopoly. So looking out into the maritime sector, so this is, as we've talked about on here, roughly 33% of the freight that moves in the country originates overseas. I think that number has actually grown over the last year. That may not be entirely accurate at this point, but it may start coming back to normal here in a bit. So we're watching weekly shipment volumes are actually down year over year quite a good bit, as we would expect, because last year was a little bit of an anomaly, overheated, but they started to recover a little bit here after. Now you see that big dip, We think a lot of that had to do with the Golden Week, the National
Okay.
Day Golden Week that happens in early October. So volumes came down a good bit for a couple of weeks there, but now they have since recovered. It is interesting to note right before peak that we still see some of this recovery effort on the on this side of things, but we do expect that to continue to decline, especially as we near Thanksgiving and go into Christmas. So like I said, the December update will be interesting to see if this trend has continued, because it is slightly up over the spring. We're seeing freight volumes continue to outperform the spring on both intermodal, on the rail, and in trucking in general. So that's somewhat a positive sign for anybody that's involved in the economy or in freight movements in general. You know, this is the customs maritime import shipments for the retail trade. So retail, big factor for the fourth quarter here. Retail trade imports down pretty significantly year over year. We've seen the peak be really muted. You see that there in February, March, we had a lot more imports coming into the country in February and March. I think a lot of that, again, having to do with the tariffs and the trade war. And so they pulled it all into the country, and we've continued to see inventory stay elevated. I believe our business inventory, just to dabble into your segment here briefly, the sales to inventory ratio is still elevated, about 1.4, which means people are keeping about 1.4 months worth of inventory in their warehouses right now. I think back in the 2008, 2009 recessionary period, it was what, 1.45, somewhere in there.
Yeah.
So again, this index doesn't move a lot. I think 1.34, 1.35 was back in the heyday. You know, that's a really good number. 1.4 is right there in the, you know, it's on the cutting edge of, you know, where we've seen some recessionary pressure.
Right.
So I think a lot of that too has to do though with the fact that we have had this pull forward.
Right.
And it's keeping inventory levels a little bit more elevated. So not necessarily means that people have stopped purchasing as much as that might indicate, but the fact that it is, you know, we are seeing a lot more replenishment, a lot more buildup of inventory.
I agree.
Yeah. So on the air side. So this one is a little bit concerning for me. We should be seeing a pretty good peak here. It is not materialized yet. We see rates coming up, coming from China or Hong Kong to North America a little bit. We started to see some rates come up from Shanghai to North America, and then the European sector is just miserable. It's way down. This is not a good sign in terms of a leading indicator for the freight market in general. This typically is one of the more volatile sectors, especially this time of year, and it's just not materializing. Now, the Europe side has obviously got some geopolitical headwinds going on right now with Brexit,
slightly,
and the auto side of things. But the Chinese and the the Chinese and Asian sector over there, really, we're just not seeing the volatility there that we might expect. And again, back to the old trade war. I think a lot of people have what they need right now. That doesn't necessarily translate to lower freight volumes in peak season, but it does have a negative implication into the first quarter. So just to give a quick update on the fuel side of things, diesel, we are still watching for any implication of IMO 2020, which is where we're all scared that, you know, the diesel supplies are going to dry up because all the ships over there are going to start using all our clean diesel, but they're all getting outfitted. Right now, the sonar users out there can actually see, you know, what the ships are doing right now, and a lot of them are they're congregating around the Singapore port, as that's one of the two places I believe that they can get retrofitted with these scrubbers and also get equipped for, you know, the cleaner burning diesel moving forward. So it looks to me at this point, we haven't seen any implication that we're going to see a reduced supply. The Saudi attack effect is still in play. We've still seen this, you know, adjustment upward on the diesel price. But recently, kind of anomalously, we've watched the retail price of diesel independently of the wholesale price shoot up nationally. If you look at that orange line right there, that's something to watch moving forward. The Saudi attack was, already adjusted for maybe a few days after. And now we're watching this weird anomalous push upward on the retail sector side. We're not really sure where that's coming from just yet. But that's, something to watch, especially as we approach the end of the year.
And is there something coming up in 2020?
No,
No, no.
that's what I know of. So yeah, that'll do it for the freight market for this month. Summarizing it, volumes contracting down, but we're essentially flat. West Coast is really, this is probably the beginning of the end for the West Coast activity.
Yeah.
Carriers probably don't need to focus as much on that as they have this year. And then we're starting to watch peak materialize a little bit, although it's probably not going to be that impressive compared to years past.
Right.
So.
All right. Thank you, guys. We do have a few questions so far. So if you have those and have not yet submitted them, please do that through the Q&A button in your control panel. We will get to as many as we have time for here in the last 15 minutes or so. Question 1, any anticipation for market segments or industries that will take a bigger increase in freight costs than others?
No, I don't think so. I think anybody that's going to see an increase is going to be outside of the material sector. It won't be production based. It'll be service based. We're seeing costs being a big headwind. We still haven't adjusted for the increasing cost. It's providing like Anthony said, basically everybody that moves something or makes something is dealing with increasing costs. That's going to keep demand side down. What we're really going to need to wait on is the supply side correction for us to see any material increase in any of those sectors. So basically your niche carriers, people like that, once those sectors, if they're particularly struggling, like we saw the automotive sector go down earlier in the month, anytime something like that happens, it's a huge risk of supply side correction because carriers don't have the cash flow in general to weather a lot of that activity.
Great. And can you guys speak to warehouse space? Is it at a premium or do warehouses still have plenty of space available?
I think most of the data that we've seen has shown us that a lot of people have invested in warehousing. We're seeing still a continued utilization factor above 80% in the country. Real estate premiums are high. So those warehouses are seeing escalations in rates year over year because that sector can see increasing activity. And again, we're going to build off of this year where we had a lot of pull forward and a lot more freight coming into these markets. We had a lot of increased investment in warehousing, however, so look for that over the next 12 to 18 months to start to subside slightly. I think that those rates will probably not increase as much over the next year or so. Great.
And how does 2020 being an election year influence what you see ahead for freight and capacity levels?
Yeah, we talked about this a little bit last month. Election years typically create more uncertainty. They don't answer questions. 2016 is an example. The freight market essentially had fallen apart, and almost immediately after Trump got elected, we saw increased spending. Now, again, this wasn't solely based on the presidential election, but a lot of the global economy, the price of oil, all had an influence here. But again, election years tend to inhibit spending, especially, when you're looking at, a Democrat versus Republican, regardless of which side you sit on, businesses don't tend to invest. And Anthony, you can agree or disagree with me, but from the data I've seen, businesses don't essentially like to invest in it when they think they're going to get taxed more.
Exactly. Yeah.
All right. Is IMO 2020 affecting fuel spreads?
Currently, no, it's not. And it's and that's something that we're, our oil expert, John Kingston, has talked about. I actually just listened to him rant about it yesterday, about how we really haven't seen it. We're about to actually put some new data in Sonar that will help us to see an earlier indication of this in terms of Brent spread versus the ULSD or rack rate. So whenever if we see something like that happen, especially if we see a trend develop, everybody will be the first to know. Watch your FreightWaves.
All right. And what are the expected trends in the reefer market in the next 2 years?
I think the general trend is going to be, pretty flat in terms of this initial phase. But I think over time, the reefer market's going to have a better recovery and a quicker recovery coming into the latter half of 2020 and to 2021, basically because they're niche. And the fact that we are becoming increasingly dependent on, produce and fresh food, the demand for that is actually on the rise, a lot more so than the rest of the dry van, the dry goods market. there's an increasing need for cold chain and the supply side management. And, right now we're going to go through a market contraction. It's going to correct for a little bit longer. We have seen reefer demand increase over the last little bit, but that feels still seasonal compared to, it doesn't feel like an upward cycle at this point. We saw a lot of shippers actually start using dry van carriers because they can control their costs that way a little bit better. And, and the dry van carriers or the shippers that can afford to take that chance at least, over the last couple of months, because the rates are so much, they're less volatile, if you will. So, but I do think eventually we will see that one correct, and they'll come out of that a little bit faster than the dry van side.
Okay. And do you have any thoughts on the potential impact of AB5 in California?
Yeah, I think, California is its own animal in general. But again, now that we're seeing contraction in volumes and that market kind of dying off the vine, I think we're just not going to see that materialize like it's the market itself. California is a place that carriers do not like to operate in general. And I think that that's going to continue. And now it's going to be even worse now that demand is off. California is kind of on its own in terms of it has so much population, so many warehouses, so much demand side implication. But I think that market is just going to really start to see a pretty rough spot here in the next couple of months, regardless of AB5.
Okay. And what impact of the U.S.-China poultry trade agreement that was reached starting this week have on capacity, and how long will it last?
I haven't seen anything on my end that has been substantial.
I haven't watched anything on my side that has shown any kind of indication. I don't know if I don't have a good answer for that one.
Yeah.
We're going into Thanksgiving, so all the turkeys are moving.
Yeah.
But it doesn't. I haven't seen anything that would give any indication that that's going to be a long-standing or hard impact.
All right. And have you seen evidence of substantial shifts of west to east container volumes moving direct to East Coast ports?
Yes, we have. We've watched that actually materialize significantly over the last, I want to say, 2 to 3 months. Has really, we have some data in Sonar itself, the customs data, as combined with our tender volume data. The Port of New York, New Jersey has grown 40 to 50% year over year, or that market, I should say. A lot of the freight volumes have grown there. And then as early as Savannah is really hard to isolate, the third largest port in the country, or the port combination in the country. And, all the markets on the East Coast effectively have seen increasing freight volume year over year, whereas Los Angeles is actually the port of Los Angeles has lost a little bit of market share in that regard.
Okay. And how should brokers react to the flattening market?
Well, everybody's going to say, go out and get your volume. And that's essentially all you can do at this point. Is you're not going to be able, the volatility is just not there right now. You're going to have peak here in a few, the next week and a half. And then, that'll last through Christmas. You're going to see that kind of diminish in the first week after Thanksgiving. So don't, be good to your shippers, be good to your carriers, because your carriers, you're going to need to be a little bit more selective with them coming up in the next few months, because you're going to see probably a good bit of them fall off or reconsolidate here in the next little bit. So you might lose some relationships moving forward. So make sure that you're treating both sides pretty good. Volatility not there, so you really don't have a lot of choice in this kind of market.
Okay, and last one. What do you see in terms of capacity growth in 2020? And do you expect contraction from recent regulatory changes like the transition to ELDs from AOBRDs and hair follicle drug testing?
We expect a reduction in capacity, not from the ARBRD. I think Dean Croak has stated that he expects only about a 1% to 2% reduction. Now that's going to be combined with the fact that there's just not enough demand out there to sustain the supply right now. The rate pressure is not there. A lot of carriers are operating in the 98, 99 OR range. So over winter, we're going to see a capacity reduction in general. And then AORBDs, it's going to be hard to isolate exactly what the cause is. The hair follicle testing, yeah, it's a thing. But again, it may just be more of a speeding up of the process versus the actual end game result.
All right. Well, it looks like that is all that we have for today. So thank you guys in the audience for tuning in today and for all of your questions. And thank you to Zach and Anthony, of course, for being here as well. Keep an eye out for the next market update webinar, which will be taking place on December 17th. So we hope you'll join us again then. Take care. Have a great afternoon.